Gold is rapidly approaching a major liquidity zone, and smart money is actively preparing its next massive move. Right now, most retail traders are completely distracted, looking at the exact wrong levels. My primary focus today is a very specific sell setup, but there is one strict condition that absolutely must happen first. Let's just cut straight to it, 3968.20. That is the ultimate sell-side liquidity target. That is exactly where institutional algorithms are currently drawing price. So before we get into the weeds, here is the absolute outcome right up front. Our daily bias is firmly bearish. The primary setup is a short entry right within the premium sell zone of 40.48 to 40.55. And the expected target? That deep sell-side liquidity pool at 3968.20. Okay, let's break down the institutional reasoning behind this. Analyzing the daily order flow, we're seeing a sustained macro bearish distribution. Ever since rejecting those parabolic all-time highs near the 5,600 level back in January and February of 2026, gold has established this undeniable sequence of lower highs and lower lows, breaking sharply below the 4,000 mark. Smart money is actively distributing into temporary strength here. We have literally zero signs of institutional accumulation that would warrant a reversal. To really build conviction on this bearish narrative, the one-week performance data shows gold down 3.27%. This isn't just some localized minor pullback on a lower time frame. It reflects persistent institutional liquidation across the entire precious metals sector. The broader institutional positioning remains heavily net short, and we absolutely want to align ourselves precisely with that macro order flow. But here's the problem for the average retail trader. They completely ignore the macro catalysts that actually drive these algorithms. Right now, we're seeing severe geopolitical unrest with US and Iran-backed strikes in Iraq, WTI crude oil spiking 4% to $81.60, and these looming FOMC inflation fears paired with Fed leadership commentary. Smart money uses these exact geopolitical anxieties as fuel. They leverage these volatility windows to engineer price action, and their goal? To aggressively sweep resting liquidity on both sides before initiating the true directional move. Dropping down to the 4-hour time frame, it's interesting because price is actually delivering into a deep discount relative to the major daily range. However, we have a crucial, totally unmitigated 4-hour fair value gap sitting directly above us, spanning from the 40.50 to 40.65 premium array. This open gap, along with a bearish order block just above it, acts like a giant magnet for price. It represents a prime institutional entry zone for shorts before we see any further downside continuation. So, before we even think about executing, we need to be crystal clear on what a liquidity sweep actually is. Essentially, this is when institutional algorithms temporarily push price above or below a key swing point. Why? To trigger retail stop losses, accumulating orders before aggressively reversing back into the true macro trend. This is exactly why the market is currently drifting upward in this low-volume Asian session environment. They are literally building the trap. When analyzing the 1-hour time frame, this dynamic becomes incredibly clear. Our current dealing range is defined by the high at 41.12 straight down to the fresh Asia low at 40.13. Right now, we're trading in the discount area of this localized range, sitting around 40.33. But make no mistake, this temporary internal pullback isn't a reversal, it's systematic manipulation. Algorithms are carefully engineering buy-side liquidity right near the 40.48 intraday high, creating a perfect inducement trap. And this is exactly where most traders get trapped. The retail focus is entirely on buying these shallow 15-minute pullbacks, assuming that a bottom is finally in. Meanwhile, the institutional draw on liquidity is vastly different. Smart money is patiently waiting for price to sweep that buy-side liquidity above 40.48, effectively using those retail buy stops to pair their own institutional short distributions. They are luring buyers in just to completely pull the rug. Shifting over to the 15-minute execution timeframe, I have to issue a serious warning. Despite this very clear draw on liquidity, smart money confirmation has not yet appeared. Right now, price is just hovering mid-range around 40.33.56 in a low-volume retracement phase. Listen, if you enter right now, you're just guessing. We need absolute algorithmic confirmation before putting a single dollar of capital at risk. So, here is the exact entry logic we require. First, we wait for the London kill zone or the New York Open. Second, we must allow price to expand upward into that premium fair value gap zone and clearly sweep that 40.48 minor high. And third, this is absolutely the most critical step. We wait for a 15-minute market structure shift back below 40.35, accompanied by energetic down displacement that leaves behind a fresh, bearish fair value gap. Without this exact sequence playing out, there is simply no trade, period. When all those conditions are met, here is the fully executable prop firm trading plan. The action is to sell. The entry zone is precisely between 40.48 and 40.55. The hard stop loss goes at 40.68.50, which is safely above the 4-hour order block invalidation level. We'll look to take our first partial profits at 40.15, which aligns perfectly with those engineered Asia session lows, and then we immediately move our stop to break even. Take profit 2 sits at 39.80, acting as intermediate swing support. Finally, we leave 20% of our position running for that ultimate daily sell-side liquidity target all the way down at 39.55. This model offers an estimated 1 to 3.8 risk-to-reward ratio. But here's the scenario most traders completely ignore. What if we're wrong? What if the higher time frame accumulation is already underway and these geopolitical catalysts actually force a massive short squeeze? You absolutely must always know the exact level where your entire thesis falls apart, well before you ever enter the market. That critical level is 40.80. A daily candle closing above 40.80.00 completely destroys this bearish institutional narrative. A break and close above that level signals a complex daily expansion straight back toward the 41.50 area, shifting the market profile from distribution back to accumulation. So strict risk management here, risking no more than 0.5% to 1% of your account, is entirely non-negotiable. All right, let's do a final rapid recap. The macro bias across the daily and 4-hour timeframes remains firmly bearish. We are patiently waiting for a London kill zone sweep of the 40.48 buy-side liquidity pool. Our true institutional target is the deep sell-side liquidity resting beneath 39.68. And remember, there is absolutely no execution without that 15-minute algorithmic confirmation displacement. Patience truly pays in this environment. If you appreciate this level of institutional-grade market analysis using ICT and smart money concepts, be sure to subscribe to ICT Market Theory. And if you'd like to trade alongside these exact setups with tight institutional spreads, you can find the FXTM account link right in the notes for this explainer. The market is sending a very clear warning signal through these charts today. The liquidity pools have been meticulously engineered and the traps are officially set. So the only question left is, are you on the right side of the liquidity?